Hey folks, Dan Frio here. We are going to talk about rate and rate sheets today because a lot of confusion comes about when people are looking, well, this is the rate and that's the rate, and you look at it in many different platforms and you see all kind of different rates. So I really want to explain to you guys how rates work and what affects them, and that's what we're going to talk about in today's video. So my name is Dan Frio. If you're watching this video, you probably watch me hopefully each day. I actually do videos twice a day to inform you guys what's going on with those over there. Sorry, it's backwards. My camera's reversed. So let's get over to it. So here's what we go over every day. So when I go into rate sheets, I go to Mortgage News Daily, and this gives me basically like what a generic 30-year mortgage rate would be. So you're going to see these in all different platforms that you go out to. And but these aren't rate sheets. Okay, what really affects your rate are a whole bunch of other things. What a rate sheet looks like is right through here. This is a mock rate sheet, and this is what I'm going to try to explain to you guys today, so you don't have to look at this and say, okay, the interest rate over here, sorry about that, I didn't want to put the company up there. I don't know who they are and don't use them, and I just found them online. But if you go over through here, here's what's, you're going to see a rate. Today's rate is 6.5, and then you're seeing 98.25 on a 30-day and 98.125 on a 45-day, and then over here you're getting the 760 score and all these numbers. What does all this mean? Well, by the end of this video, hopefully you'll be able to figure that out and you'll understand how exactly all this works. So let's get over to it. So here's what mortgage rates are. And I try to explain this when I do videos, and I stopped doing it for a while because people were saying, okay, Dan, you don't have to say it every day. But if you actually even go into Mortgage News Daily, they're going to give you a rate right here. So what does this rate consist of? Is it 100% financing or what? Well, you actually have to go over to this right here and you click it, and it'll explain to you what this rate consists of. So if we go over to it, this rate actually consists of this client. So let's scroll down. This borrower has a 75% loan to value. Okay, that means they're putting down 25%. They have a 780 credit score. And that's about all that it's telling us. But there's so much more to this equation. So let's get back to it. And so this is what we're going to talk about today. So I want to go over the first thing, the things that will affect your mortgage rates. And then we're going to go through the whys. And I'm going to show you some tools you can use to help this out. So let's get over to it. So how mortgage rates are created. The first thing you have to understand, and we go over this every day, is the mortgage-backed securities. The mortgage bond that actually creates the rate on this. So let's go over to it. Mortgage rates begin with a mortgage-backed security market. The MBSs are a bundle of home loans sold to investors. Lenders sell your mortgage to Fannie Mae and Freddie Mac, who then packages it up as an MBS, and then the MBS goes out for sale and to the open market as a bond. So when you focus in, or when we look at this every day, what's going on, we just focus in on what the MBS is doing, and we look at right here. So this is the MBS market. This is a mortgage bond that's trading on Wall Street right now, and here's what you're seeing, click by click, and you're going to see this move as we progress through the video. A lot of people look at the 10-year Treasury, but there's not a reason why to look at that unless if you don't have access to the MBS market, then this might be a good catalyst to look at. You can look at this, and whatever direction this is going in, that's probably the most likely direction that the mortgage rates are going in. But there used to be a correlation between the two, and it would be this. You would take the 10-year Treasury, you'd add 1.5 to 1.75 to this number, okay, and that would be what the 30-year fixed rate would be. So if you do that today, we go over to 4.2, we'll say 4.25 plus 1.75 would make it 6. Well, why in the world is rate 6.75? That is a risk-adjusted premium, and there's a whole bunch of other pieces of the puzzle that create this. So let's get over to it. So not only is it, so hopefully that will explain to you the mortgage-backed securities market. So as the number goes up, here's what you have to focus in on. When you look at the 10-year Treasury, it's actually going to tell you the bond yield. Okay, so the bond yield right now is 4.289, and you might see this changing as we go through. But on the mortgage piece, it actually gives us a price. Okay, so you might scratch your head there and say, okay, how does this affect rates? Well, all you have to do is know this piece. If this bond price is going down, that means mortgage rates are going up. Okay, there's an inverse relationship. Let me explain to you how it works. This is how bonds work. So if you ever see a price up here, you can actually understand how a negative price would actually bring rates up, and a positive would bring it down. Let me explain. So this is a bond. So let's take, for example, it is a mortgage bond that matures, and at maturity, it has $100 face value. So that means whoever holds that bond, when it comes to maturity, you hand it in and you're going to get $100 back. Okay, I'm going to show you how if we go up, rates are coming down. Okay, so we're going to make this example and just make it simple. Let's say today, or let's say I bought the bond for $50. Okay, so I bought the bond for $50 and I got the bond. And then when it came into maturity, I hand the bond in and I get my $100 back. That's the face value of the bond. What was my yield, or what was my rate of return? I doubled my money. Okay, so that means the rate or the yield was 100%. Okay, so 100% at the $50 mark. So now I'm going to show you how if prices go up, rates are going to come down. So let's say, for example, in this situation, I paid you $100 for that bond. Probably sitting there scratching your head. And then so when I turn in my matured bond, I get $100 back. Well, what's my rate of return there? I paid $100. I got $100 back. Zero. Okay. So see, when the price goes up, when it was at 50, my yield was 100%. When it was 100, my yield was zero. So as the market goes up here, and you'll see on a 5-day chart, as this market goes up, rates are coming down. It was a much exaggerated uptick, if we could fill in a couple days under here, because it was a huge rally last week, and this week we're just kind of treading water. So that's the MBS market that I need you to understand. So the other things factor into this. Let's get to it. From the MBS yield to quote rates. Okay, investor yields expectations determine MBS prices. So when these mortgage bonds go out to be sold, investors buy them. Lenders drive a par mortgage rate by adding service costs and agency fees to the MBS. So we'll skip that right now. So the next thing is introducing LLPAs. And if you watch my videos, you hear me a lot of times saying, well, we take the yield on this bond and we add in LLPAs, and then the profit margin thus equates out to the interest rate that you're going to get. Well, LLPAs are things like this. And let's get over to, I'll show you that rate sheet. We'll go back to that rate sheet that we were looking at. So here's LLPAs. You can read that right across the top there. These are all the adjustments, right? They're here, if you're locking in a rate. Now you can see why it's automated, because you're going to have to go over here and say, okay, so let's break it down a little bit. Down over here at the top, we're going to start over here. So let's say the par price, meaning right here, this is going to be at zero. What this means to you is right now, you could get a rate at 6.875, the rate right there, and it's par. It wouldn't cost you any money, and you won't get credits back either. And I'll show you how that works. Usually if there's a positive number, that means you're getting money back as credits. If there's a negative number, that means you owe it. Okay, so let's say the par rate today is 6.875, and you're saying, that's a great rate. Well, let's hold on a second. Let's go and start adding in our LLPAs. Okay, so for example, we're going to take a credit score, and we're going to let's do say 2 or 3 examples. I'm doing this on the fly, folks, so bear with me. We're going to take somebody with a 680 credit score, and then we're going to look at somebody with a 740 credit score. Okay, each one of these are going to put down 10%. And they have a credit score there, and there's really nothing else really weird with this loan. So let's get over and see what rate we can get these people. So at a 680 per loans credit score, you're seeing it right through here. Now we have to move over to this section. This is where going to be your credit score hits, and then your LLPA, loan level price adjustments. So this is your price adjustments for your credit score. This is price adjustments for everything else. That's why a lot of times when you hear me talk, I'll say, well, the price on that one is, and the reason why I do that is we talk price as our lingo in the industry. So that's what we're seeing through here. So let's get over to it. So right now, this person has a 680 credit score, so they'd be right through here. They're going 10% down, so they'd be all the way over here. They can't go 10% down in this category on this rate sheet. You can, but let's get over to it. So let's just say in this one, it's an 85% loan to value. So they're putting down 15%. Okay, so let's make sure we make that adjustment. Okay, so they're putting 15% down. So this 680 person has a 3.625 hit for their score. Now let's go down to see if there's anything else they're looking to purchase. If we go over to that, there is no hit for the purchase. So let's just say they're going with the purchase right now. All right, so what this means now is we had a 3.625 hit. Well, now we got to go back over here, and we got to bring this all the way down to 3.625. Because that's the loan level price adjustment. So you have to take this price that you're getting right through here, 3.625, move it over to here and start putting it into this number to bring this number back to 100%. So we go over here, and this is a deduction. So 3.625, it's going to be all the way down to, so this person, instead of getting 6.875, as they were expected before you put in the adjustments, now the rate is 8.375. Okay, so see the differences here. Now let's just say another example. Let's take now this to a 740 credit score. So let's take the same adjustments. And again, we'll use 15% down. 740 credit score. You go over to the 85% LTV. Now we have 2.375 is the negative. And again, we're going to say there's no other adjustments down through here. So you're going to go over here, sit at the par rate. Now you're going to have to go to 2.3. So this person would get 7.75. So that's how it works on your credit score. That's just the differences on credit score only. Now let's get down to some of these other things. I'm not sure if you can see this on your screen or your TV. So let me see if I can open this up a little bit more to make it, okay, so that's about as big as I can get it. So now let's do a scenario. I have a lot of people calling in for cash out refinances. Okay, so there's different ways you can refinance your mortgage if you're looking at refinancing or if you're looking at purchases. Well, let's just first go over a purchase transaction because most of you probably are watching this for a purchase. So let's say, for example, you have, and you're like, Dan, I am fantastic. I have a 780 credit score. I'm putting down 10%, and I'm buying a 4-unit building. Okay, well, it is possible to do that. So let's get over to this. Okay, the first thing we're going to go over here and say this is going to be a 780 credit score, so it's all the way out the roof, so that's okay. Going to go over to 90% LTV. Now, again, this is the rate sheet for this bank. This isn't very common, what I'm seeing right through here. So the 760 credit score at 90 LTV, because they're putting 20% or 10% down, is 4.25%. Holy shnikes. Okay, so now they're buying a 4-unit. So now we got to go all the way down here and start making these adjustments, if anything. So this is saying a 4-unit building. Now I've got to take a 0.5% or 0.5 off of that as well. So I have to add 0.5 to the 4.25. Now I'm at 4.75 in adjustments. Okay, so this person would be looking up here as par. Now we have to roll all the way down to 4.75. So instead of getting a rate at 6.875, their rate would be 8.875. That's how detrimental all these adjustments are. So this is why, in most cases, when you're working with me, I'll ask you a multitude of questions. I need to know what your credit scores are. I need to know what kind of property it is. I need to know all these things over here, because if we miss it, it could be detrimental in our rate quote. So a lot of times somebody will come to me and say, hey, Dan, I got a rate quote. And I was actually watching one of the crash people yesterday, and I don't know why, but the guy was on there, and he's talking to his audience, and he said, yeah, I'm looking at buying a house right now, and I got a quote yesterday on an FHA loan at 5.25%. 5.25%. I'm like, dude, it ain't possible. You go over here, when you start seeing FHAs or you start getting a rate that's way off of this, there's going to be a problem. They might have missed something, because if you go back to this, you can easily miss an adjustment. So let's say, for example, I'm like, I went over to your credit score, and I was in this situation. I'm like, okay, you got the 780 credit score, and you're putting 10% down. You know, we do have an adjustment, but we miss an adjustment down here. Let's say, for example, where's a big one that we can pull out here? Your credit scores are usually the biggest hit that you're going to see, but like in this case, you might have an adjustment because the loan amount is under $150,000. This bank is hitting you 0.75 to the price over through here for that. So let's look at another one. Here's where it really gets tough. If you're looking for a cash out on a condo with low scores. Okay, so let's go over that scenario for you. So we're going to go up through here. Let's say the person has a 720 credit score. They're looking to go 80% cash out, and it's a condo. Okay, so let's see how bad these rates are going to be. Again, we'll start up here. The start rate is 6.875. There's always a start rate. Okay, and that's why a lot of times when people come to me and they're like, oh, Dan, I'm getting a rate at 6.25. I'm like, dude, you can't get a rate at 6.25. It's not even on the board. So that's for another time. So let's go back with this. We got a 720 credit score at 80%. So let's go across the board at 720. So my hits are 1.375 just for my score, 1.375. Then we're going to go down here. This is a cash out. We're going to go all the way up to 80%. So that number right there through there is 0.75. 0.75. And then now it's a condo. Let's see if they have a hit for a high-rise condo or a low-rise or non-warranted condo. In this case, we'll just go with a high-rise condo. There's another 0.625 to add to that. I can't even do the math on this one. Let's say, is there anything else there? Cash out, reserves, rate and term. Okay, so now what is our adjustments? I got to get my handy calculator out for this one. We got adjustments at this. We have, bear with me, folks. We have an adjustment at 1.375 for the score, plus 0.75 plus 0.625 equals. So now our total hits are 2.75. Again, we go over to the par price at 6.875. Then we have to move down to 2.75. So that would be the rate, 7.875 versus, let's say they just messed up something. They might have quoted you 6.875. So then they realize all their, everything, all the details of the loan, then they're going to come back with this. So that's many times how a loan officer could kind of mess up. They can either just not read the rate sheet correctly, or maybe it might be even that you didn't provide some of the information to them. So that's when I go on here try to go on and explain to everybody, there's a lot of factors that come in when you're looking at rates. So if you guys have any questions, we'll continue to go through this, but if you guys have any questions, I'd love, Honey Buns, you're scared. I get it. So Honey Buns, thanks for joining me once again today. You come in all the time and you tell me you're scared, and I appreciate it. That anybody else on here that I can answer any question? What's your price? What you pricing out? I just got here. So Sean, let me know if you have a scenario that you'd like me to price out. Let's say, for example, here's what I just priced out. We'll do one more so I can show it to you. Let's say you have someone buying a home. Okay, they're going to buy a house, and let's say their credit's bad, but they need a high loan to value. Okay, so let's say that. So let's say, for example, in this case, their credit score is 660. They're going to put down, what's the minimum there? It's saying 80%. That's not it, but we're going to go 80% financing, and this thing is it's a 2 to 4 unit building. Okay, so that's what we're going to look at, and it's cash out. So let's look at these hits. This is where it gets nuts, and this is where you really have to have the correct information to get a correct quote. Okay, so we're going to start with this. We got a 660 credit score, so we're going to go over here at 80% loan to value. We have our hits of 3.625, so let's write that down. 3.625 is the hits that you're getting because of your credit score. So what we're looking at right now, again, this is a rate sheet with all the adjustments on it. Okay, so let's get over to this. 660 credit score at 80 LTV. We got a 3.625 hit. This person is looking for a cash out, so there would be another 0.75 hit for that. They are at, where is it? It's a 2 unit plus, so there's another 0.5 hit for that. And there's their cash out. We hit them for the cash out, 0.75 cash out. And what did we say? Oh, I think we said it's a condo to boot. So it's a condo. Now we got another 1% hit. Let's add these things up. This is where it gets crazy. So this is where I've been saying, if you're looking to cash out, you really have to, the lower the loan to value, you're seeing right through here, the lower the hits. If you go down to cash out, where is that cash out thing? Right through, it's right at the top, cash out right through here. You can see going from 70 LTV to a 75 LTV right through here. There's a 0.5 point difference to the cost, not the rate. So there's always things when we talk rate or we talk the price or the cost for that. That's the differences that you're going to see here. But let's just go back through this condo. So our hits were 3.625 plus 0.75 plus 0.5 plus 1 equals 5.875. That is our total additions that we have to this rate. So again, we go to our par rate, 6.8. We have to go to 5.875 down here. The cash out rate, even though today's rate is 6.875, if you're in that scenario, you're looking for cash out, your rate would be 9.5. That's how it works. So when you're applying for a loan, what you got to make sure is, one, the rate quote that they give you is realistic. Okay, so like I said, I watched a young man's video yesterday, and he was talking to his audience, telling them that he got pre-approved at a rate at 5.25 on an FHA on a 30-year fixed. And I called him out, and obviously he started screaming at me and doing everything else. But here's where the FHA rates are, folks. So if your rate is substantially lower than this, be careful, because this should be a pretty darn good entry point for you when you're looking at rates, because when you see these rates on Mortgage News Daily, it's basically somebody with a great credit score. They're putting down 25%. So this is basically one of the best scenarios that you can be in. So when you start looking at or getting rates, and I'm getting a 6% rate on a 30-year fix and it's a condo, please be careful, folks. You have to really be concerned about that. But what happens a lot of times is when people have those kind of quotes, the first thing I'm asking them is, how much in fees are you paying? Because you could see through here, let's say, for example, let's go back to our rate sheet. They can charge you this in points. So what a lot of builders are doing right now, they're saying, okay, I know our rate is 6.875, but I'm going to give you a rate at 7.75, and I'm going to give you credits back. Because they're giving you credits back, because they're getting credits in there, and maybe there's no adjustment. So that's how you can get, a lot of times you get free loans, but a lot of times what the builders do is many of them own about 50% of the mortgage lenders out there, and they'll kind of manipulate these numbers because they're giving you credits on one side of the ledger, and they try to make their money back on this side of the ledger. But a lot of builders are doing a fantastic job with this. But please be careful when you're out there, you're looking and you see a lot of these advertisements. For example, I was just posted in here, let me find it. I'm excited about myself because I was posted in Yahoo Finance the other day, and I'll show you that article that Dan Frio and Yahoo Finance. I'll show you the article that they posted, and this is probably a great example to show you guys how interest rates work. So let's go up to here. Right through here, they actually reached out to me about a week and a half ago, and they said, Dan, when you're working with clients, what do you talk to them about? Because a lot of people are concerned rates are going to go over 8%, and a lot of them are concerned that, when and where and why would interest rates get back to 3%? And I was like, well, so here's the article. I'd love for you to check it out. What happens if mortgage rates go all the way up to 8%? But what I want to show you in this caption is, here's where the rates are. Okay, so this one is basically 20% down, purchase, 780. Look at the disparity in the rates. You have Sage. I'm speechless. They're saying they can give you a rate at 5.84 with 1.9 points. Then you go down here and you have this other bank at 6.09 with 1.9 points. Then you have this at 6.7 at 1.5 points. Folks, it ain't even close to these rates here. How in the world is this person putting down 25%? They have an 800 credit score basically. So how are a lot of these people getting, these rates? It's marketing, folks. It's marketing. Please watch the bottom line. You can see down here, $8,000 in fees. $8,000. So please be cognizant. Don't be wowed saying, whoa, this rate's fantastic. It's going to cost you. This doesn't come free. Let's see what the I think. 360 equal payments. I'd love to know what the fine line is on there, but I'm not going to waste my time going through there. So let's go down through here. They were talking about, what happens if mortgage rates go up to 8%? Well, let's go back over time. Rates were at 8% almost about 2 years ago. What happened to the housing market? Did prices tumble? They didn't tumble. And the reason why is people aren't selling their homes. So when you only have a small amount of homes, and you hear it all the time, even though we have a record number of inventory right now, there's still a lack of supply. A huge lack of supply. So unless you have a robust increase in inventory, house prices don't have the ability to crash. Now you're going to have areas such as Austin, some parts of California and Florida that are going to have massive amounts of probably homes coming to the market. You might even have areas where they got hit by a hurricane that still hasn't even been fixed yet. So there's a lot of reasons for a lot of these areas to being depleted right now. But just be careful out there. If you're looking to buy a house, please make sure you reach out to us and get pre-approved, and also work with a realtor in your area that really knows the area. But if you go over here, they asked me the question that says, are you still having people ask about the 3% rates? And I was saying, yeah, but I try to explain to the clients, especially on my channel every day, the reason why rates were as low as they possibly were was COVID. And the Federal Reserve stepped in, and what they did is they started buying up mortgage-backed securities. They started buying this bond right here, driving prices down, 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 and down. I'm sorry, up, 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 and up because of the robustness they were buying with. As they jacked those prices up, rates hit like 2% back in 2020 because the Federal Reserve was buying $40 billion worth worth of these bonds on a daily basis. Well, the Federal Reserve is no longer buying these bonds. They're actually a net seller of bonds. So you have more pressure on bond prices right now with excess bonds out there, along with the Federal Reserve selling. So that's holding this market back from just skyrocketing. So we have a lot of things hitting the market, but not a lot of bond buyers right now with mortgage bonds. When you go buy 10-year treasuries and so forth, at almost equivalent yields with no risk. So that's that part of it. So let me get to answer some of the questions that you guys have out here. So let's go over to, what's the first one? Did I answer this one yet? Let's get over to it. Do you get a lower rate the higher the down payment you have? Yes, you do. So let's get over to that real quick. So here's what it looks like. You can see, here's your loan to value across the top. I hope you guys can see this. And this isn't a standard rate sheet because some of these don't exist. And you can, with a 680 credit score, you can go to 90% financing. So I'm not sure the precision with this, or if this is their own customized rate sheet, but it looks pretty darn good. But some of these cells should be filled in. Okay, so let's look at what you're looking for. So right through here, here's the down payment or your loan to value. So let's just work it the opposite way. So what this loan to value is up here, what that means is the loan amount divided by the value of the property. So for example, if you're looking to put 20% down, well, you're looking at an 80% loan. Okay, so that's how it works. So let's look at it. So if you're putting 10%, well, let's look at this one. If on a 760 credit score, if you were putting 90% down, or 10% down, I'm sorry, you would have a hit of 4.25. So let's just start there. At 90% or 10% down, we go over here in 760, we have a 4.25 hit. We go over here, we go down to 4.25. Your rate would be 8.625 versus the par rate at 6.875. Okay, don't freak out. This rate sheet isn't really good, but it was best comparables that I can use. Okay, so if you're putting more money down, let's get over to here. Let's just dump down. Let's say in this case, you're putting 20% down because you only need an 80% loan to value. Well, in this case, you'd have a 75 basis point hit, 0.75. We scroll over here. And in this case, you would have a rate at 7.125. Much, much different. This is how it works. So these adjustments here are for your credit scores, and these adjustments here are for everything other than your credit scores. You can go from an interest-only program, purchase, rate and term, cash out. Let me explain these to you as we go through, so you might just be interested in what these really mean. An ARM is adjustable rate mortgage. Interest only, it's not available on all products, so let's just scrap that for now. Purchases, obviously your purchase on a home. Rate and term, what that means is you might get questioned, especially from me if you're looking to refinance, are you looking for a rate and term or what's called a cash out? Okay, a rate and term, what that means is you're just refinancing your current mortgage balance. That's all. You're just doing it to get a lower term, or maybe shorten the rate or lengthen the rate, whatever your case there. But you're not looking for any money. Now, if you're looking for any money and it comes to $2,000 or more, here's what you're looking at right here, a cash out. Okay, next thing is this is cash out for reserves. I don't really see that being standard as well. Then you have debt ratios. That's usually not all that standard as well. And then you're getting loan amounts. What kind of unit, how many units it is it a condo, so there's a whole bunch of other adjustments up here that can really add up. And that's basically how that works. So Amber, thanks for the question. Let's get to the next one. So what are we seeing here? What loan amount? It doesn't matter the loan amount. I don't mean to laugh, but it's like loan amounts can vary. This one is a little unique. This one says under 150, under 150 to 200. 500 or more. So there might be adjustments in there for the loan amount. Usually what happens is most lenders cannot do a loan when you're looking about $100,000 or less. Not because we don't want to, we can't do them in most cases. Because a lot of the legislation that went through during the Great Crash, part of it was called the Dodd-Frank bill. The Dodd-Frank bill put caps on fees that lenders can charge. So in many times you can see where these rates get so high, we can't even do the loan because of the rates too high. Or let's say, for example, it's a $100,000 loan. Usually you're going to have an appraisal fee and other fees that really count toward the high cost limits. In most cases, it's 3% of the loan amount. You can't exceed that in loan fees, or you can't get a loan. It won't get approved. So that's why in most cases you can't get a loan for $100,000 or less. So that's why that kicks into play a lot of times. So let's get to the next question that we might have. What is the best, here, let me add this in. What is the best strategy to get a good rate doing a construction loan, or a good way to structure it? So Trevor, the best way I would do a construction loan, if I'm assuming and you can answer me, are you going through the builder where they're giving you lender credits? Okay, so that's what, let's just assume that for now. So let's see how we would use that. So let's say, for example, you were going with your lender, your preferred lender, and they're giving you $10,000 in credits. Okay, so what you're going to do is go over through here. The first thing I would do is I would use my costs, or my fees, or my credits, to pay all the fees that you're going to get hit for. Okay, let's get to Trevor. Let me get out of there so you guys can see me. So we ended with Trevor. All right. Hold on. We'll answer your question. I just wanted to figure out where I'm going to leave off at. Okay. So you want to take your lender credits and pay off all the fees, except don't do anything with your rate just yet. Okay, so we want to pay off all the fees, and usually the fees are right in line with the standards, because they're using national title companies and everything else. So that's not the issue. So you want to ask them you want a par rate. You want a rate that doesn't cost you anything. Okay, that's where you want to start, because you really want to see what your starting point is. All right, then from there, let's say you have some extra money left over. I'm going to show you a tool here. Let me see if I can find it in my data files. The 2-1, here, you can go through here. See if I can pull up. I'm going to pull up a calculator for you guys. That it's called the 2-1 calculator. If I can find it here, I'll be able to find it on my files. So I'll pull it up here in 1 second. Let me get that up here. Okay, so here's a tool I want you guys to use, and I will post it once the video is over. I'll post it down below in the on this channel. So here is a temporary buy down, and here's really what I want you guys to try to work on if you got excess credits if you're working with a builder. So first thing is, we're going to use all the money, any money that they're giving us, to pay all the fees. We don't want to pay any fees. Okay, we want to pay the title fees, everything else. Okay, so here's what you're going to do. Any extra money, we're going to go over to this. This is your temporary buy downs. When you ever hear of like a 1 buy down, or a 2-1 buy down, or a 3-1 buy down, here's the calculations behind it. And I'll make this as simple as I can. I think Trevor, you answered my questions. Let's see what we got down here, bud. I'm building a house with a custom builder, 2,000 square feet. God bless you, brother. $400,000. You gotta be in California. Trevor, you in California, buddy? That's one hefty price for a 2,000 square foot home. But God bless you, brother. So here, let me just continue down that path. But I'll answer that in a second. But let's get over to this for anybody using a builder, like one of those major builders out there. So what we're going to do is we're going to take your loan amount right through here. We're going to take your loan amount. Let's say in your case, your loan amount is let's use a $400,000 loan, just to make it simple. Let's say the loan is $400,000, and you have you're getting quoted a rate at 7.25%. Okay, so here's how the temporary buy down works. Okay, so what happens is there's various denominations you can do. You can do a 1 buy down. You can do a 1-1 buy down. I'll explain all these in a second. You can do a 2-1 buy down, or a 3-2-1 buy down. These are the most common available buy downs you can, and not all lenders will do this. Most of them will do them nowadays. Okay, so here's how it works. And this money can't be paid by you. It has to be credits from your seller or your realtor or somebody. This cannot be your money, and you'll kind of figure that out here in a second. So here's what the loan amount is. Loan amount's $400,000, rate 7.25. So if you have extra money in the tune of $3,100 right through here, you can do the 1 buy down. Okay, so here's how it works. So every month your true payment is right through here. It would be based on this $400,000 loan, 7.25 rate, 30-year term. Your payment, principal and interest, would be $2,729 right through here. Okay, but because you did the 1 buy down for the first year, your payment's going to be calculated on a rate at 1% lower than the rate would be. Okay, so your locked in rate, your permanent rate, we'll put it that way. So here's what that payment's going to be, $2,463, okay, for a difference of $266 a month. So here's how this works. We're going to set aside $3,190 in an escrow account. Okay, every month, $266 is going to come out of here to subsidize your payment. Okay, so, well, after 1 year, after 12 payments, all the money's gone. So you've had that lower payment for 1 year. So that's how this works. If you want a 1-1 buy down, kind of works the same way. If you want a 2-1 buy down, it's basically the same concept, but year one, you're 2% lower than the permanent rate. Year two, you're 1% lower. That's the 2-1. And then here's the adjustments. So you'd have to have $9,429 set aside in escrow to basically subsidize your payments over a 2-year time frame, and then all the money would be used up. Now, here's the benefit of this. Let's say, for example, you did this right through here, but in 6 months, mortgage rates dropped, and you're like, well, I can refinance, and don't forget that your real rate is 7.25. So even though you're paying this lower rate, don't make that the end all beat all. And here I'll explain why. Let's say, for example, now you can refinance at 6.5 or 6.25 or something like that. Well, here's the benefit of this. You might want to ride that out, but if you refinance it fairly quick, you're going to have a lot of this money left over because you're only going to deplete this by how many months you make payments and how many months it's going to have to be subsidized. So let's say, for example, you did a 2-1 buy down. After 6 months, you're like, okay, rates came down, I can refinance. Well, here's what you're going to have left over. You're going to have half of this left over because you only paid 6 months. So that's going to be $3,100 there. Then you're going to have $3,100 still remaining for the second year. So you're going to have $6,000 in credits that's either going to be applied to your payoff when we look to pay it off, or you might even get it back as a credit, depending on how your lender works with these. You might even get a check back for this just because you didn't use up all the credits. That's how I would use my builder credits, and especially in today's market. Now, if we're in an environment where rates are stable or they're going up, I would just hold on to this as long as you can, or maybe even look to do a permanent buy down. But this is actually a good program if you know rates are coming down, as we know there are right now. So great question, and let's get over to your let me try to finish your question. Let's see, getting a loan from a bank, not the builder. Trevor, I would love to be able to give you a quote, my friend. So let's see. I think you said Utah. Okay, Utah. So you're out in the high rent district. Okay, so God bless you, brother. What I'd like you to do is, if you could reach out to me after this video. Let me see if I can post my information up there. Just shoot me an email if you would. And I'll respond right after this email. If you give me your phone number, I can even give you a quick call. We can go over your scenario, and I can let you know if how to guide you, kind of going forward from there. But thanks for joining in today, and thanks for asking a question. Let's get over to Trevor. Where did we leave off? Trevor. Let's see. We got the next one. I don't know if I'm in the right. Massive buy down at 5.25. Massive buy down at massive buy down. Yeah, I don't. Unless you're talking about the mass, I'm not quite sure what you mean by that. My apologies. I agree. Our house has been on the market for 5 months now. Tennessee, they're just sitting right now. We're hoping a drop in rates could sell. Here's what's happening, Amber, and this is what I think. We saw just kind of the market just go in regards to buying and refinancing. I think what most people are doing right now, especially on the selling side or buying side, is they're just waiting. I mean, we're seeing that here on our end. When rates hit when was it? The beginning of the year, I think they were down quite a bit. It was going crazy. Then all of a sudden there was a jump in rate and the phones just stopped. And I've talked to other brokers, lenders, and so forth, and they were like, it was like 3 weeks ago, we're all calling each other. It was like, dude, your phone on? Because it was like there was just no activity in the markets. But you'll see, I think everybody's just on hold right now. If you have a job, maybe you don't know if it's all secure or not. If you're waiting to buy, well, what's the market going to do in your area? Is it going to come down? Maybe by waiting, I can get a better price on that. By waiting, a lot of these tariffs going to come into effect and everything else to bring down rates. So if you're on the buying side, I kind of hate to say it, but I get it, where you're just trying to stay tight. But the problem is are you going to have to renew that lease again for next year and then be stuck again for a whole nother year? And I don't mean stuck, but putting off the plans, if you're looking to buy, putting off those plans for another year. So if you guys really need some consultation with this, reach out to me. I'd love to help in any way. I'll just shoot me an email. If you want me to give you a call, just give me your phone number. If not, I'll just email you back. And if you give me some specific data, I can actually go in and do some rate quotes for you. Let me answer a couple more questions, and then I do want to go over to this right through here. This is our search engine. Now, this is the grand poobah of what we do. Okay, so folks, I want you to understand when I come out there and I talk about, we're going to analyze your credit report. Here's our slogan, and I go to the rate right through here. I said our slogan at the rate update is this: one application, one credit pool. We're going to shop your loan to over 30 different lenders. Now, let me just give you a sneak peek on how we do this. So let's get over to here. I'm just going to run one scenario through here. Let me see if there's any other questions that we can answer while we're through here before I go here. Let's see what we got. We have our next house already under contract. Would you suggest we lock in right now or wait? I would reach out to me and make sure you get a rate quote or a best quote, and then we can work on locking you in. No, I would. It depends. I don't like floating into weekends, especially when we don't know what tariffs and tax bills and all that are going to do. I would, I'll put it this way: whatever your lender would suggest. If you were working with me, I'd love to consult you with all these things. Right now, I locked in some people yesterday before there was a little bump in rates. Here, let's go to a two-day chart. Yesterday, right when this jumped, right in the morning, and we went throughout the day, I was locking people in because I'm like, we got a nice reprieve. Again, as this number goes up, rates come down. So yesterday I was locking people in. Now we're down just a little bit on the day. I might be just sitting on this is a 10-year Treasury. My apologies. Let's go to a two-day chart. Right through here yesterday. Oh, I'm sorry. I locked people right through here yesterday before the markets really gave anything back, and then we're down here right now. So let's look at a 5-day chart. Really, rates aren't doing much of anything. So if I'm going into this, I'd be floating most likely into the weekend. But tomorrow we're going to get some news on the employment numbers, how that comes out. That will be, if it comes in as bad as the ADP numbers today, there might even be a rate cut at the next meeting, even though there's not supposed to be. So that's that part of it. Let's see if we can get any other questions. And I'm going to run a scenario or so. Let's see if we got one more here. Shout out to Dan. Hope you're doing well. Thanks, Ben. I appreciate it, Jose. Happy birthday. Hope you had a wonderful day. Yeah, folks, my birthday was last Sunday, the 22nd of June. I do have a link down in my descriptions if you guys want to buy me a coffee. Just saying, it's down there. You can actually buy me a cup of coffee for like $3 or something like that. It's whatever. But let's get to the last thing. What is your email? I missed it when you put it up. It's dan@therateupdate.com. Pretty darn simple. Okay, so let's get over to this. Here's what we use. So again, when I talk about myself, I say, hey, folks, this is Dan Frio. I'm a federally licensed loan officer. Let me go through it. I'm a federally licensed loan officer, folks. So what does that mean? I got that question yesterday. That means I'm licensed in all 50 states as well as Puerto Rico. So no matter where out there you're looking, I should be able to help you. If you guys are out here and you're saying, okay, Dan, should I lock or float or whatever, guys, at least give me a shot at this thing. So I'm going to give you how I can review your loan estimate if you're locked in or if you're not locked in yet. But first off, I want to show you what we do behind the scenes. So we have a slogan. One application, one credit pool. We're going to shop your loan over 30 different lenders. Here's how we do it. Okay, so my bank I work at, it's a federal bank, which is really weird. It's a federal bank and also a huge mortgage broker. Okay, we keep adding lenders on and on and on. We're probably going to purge it a little bit because we don't need as many lenders. We have some really, really good ones. We just want to, increase our productivity with them. But let's get over to this and I'm going to show you how different rates are across the country. So let's get over to one of these and just go through, and I'm just going to put in a kind of a really nice scenario. So let's say somebody's buying a $550,000 home. They're putting down 25%, so they have a 75% loan. They have an 800 credit score, and they live in Chicago. So 60623 maybe, I don't know. Yep, there we go. All right. And let's hit this. It's a single family. It's all kind of other things. It's not a first-time home buyer. It's just somebody looking to buy a house with 25% down. Let's plug this in. So what it's doing right now is it's searching all over with all the lenders that we work with, and it's telling us who's got the best rate right now at this second. Okay, so here's what comes through. These are all lenders. Okay, so here's how this works. We'll usually go with the top one right here. This says Loan United. Go across here. Here's your rate. So when you get a rate, you see this here. All right. When you see this over here, anytime it's green, that means you're getting a credit back. So it's 6.625. In this scenario, you get a $1,500 credit back. Okay, so let's just change something. Or let me just go down through here. So this is how. So let's say, for example, you went down here and you called, let's say, United Wholesale Mortgage. Well, you can't really call them because they only deal with brokers. But let's just use this as an example. If you went there and used their jumbo yellow product, you'd have the same rate, but it would cost you $11,000 in fees or points. This is how the search engine works for us, folks. So this analyzes and pinpoints down to us the exact place that we should be taking your loan. Now, many times it might give us a lender that we just don't really like, and we know their underwriting's terrible, we know their turn times are bad, so we might not use them. But that's reason why is we have your best interest in mind. We don't want to put you through that. Even if it's got the best rates in town, they might just be horrible to work with. So I don't want to have to put off your closing for 2 weeks. I don't want to have to do any appraisal issues. So that's why we're seeing it. The other thing you see through here is every one of these is going to say wholesale. And what that means is you can't get access to these. You might be able to get access to this lender or bank, but you can't get access to these rates or fees because we do huge volumes with all these lenders, and that's why we get these. And we also use their wholesale division versus their retail division. It's kind of like going to Costco when you're looking to buy toilet paper. You go to Costco and you buy 50,000 toilet paper things, and it's a penny a piece. But if you go to Kroger's or Publix or Jewel, that each thing of toilet paper is $1 or $2. So buying in bulk, buying in wholesale helps you buy at a cheaper price. So that's what we're seeing through there. So let's get, what was the question I was supposed to get to? I forgot what that question is. Let me see if I can get back over to it or see if we have any other questions. Let's see. Did I answer these? Let's see. Happy birthday, Dan. Thank you so much. What is your email? Trevor, I just put that up there, and perfect. Send an email. I will be calling you right after this report. So that's what we're seeing through there, and that's how this works. Now let's go back. Let's go back and make a few adjustments. So in this one, this person could get 6.625. Now let's do this. Let's say this person now has a 680 credit score, and they're only going to put down 5%. So they're getting a 95% loan to value. Let's click this and see how bad those rates are. So you can see right here, Loan United seems like they're the top of the heat. They're 7%. Okay, that's a pretty big variance from where we were previously. So these are why we really need all your information. So now let's really break down all the pieces of this puzzle when it comes down to that mortgage rate. Okay, so now we're starting to understand a lot of these. Hopefully you understand the mortgage-backed security market. We understand LLPs a little bit. It's credit scores, different types of loans and things like that. So here's what really affects your rate. Your credit score, loan to value, occupancy type, loan purpose, and property type. Hopefully we're able to kind of explain all those to you. Now, here's a piece of the puzzle I really want to show you too. If you're looking for credit and assistance with your credit, please do go to this website before you hire anybody or really do anything else. Because I created this website probably at least 10 years ago. And the reason for it is I wanted people to understand their credit. Okay, so I actually created this website, and I try to make this as much stuff on here as free as I can, because folks, I'm tight with my money, probably as tight as you guys are out there. So when I'm looking at my credit scores, a lot of people don't understand basically how credit scores work. So go to this website and just look at the fundamentals of it. But this one is going to say, it actually says free credit scores, and it is a free credit score system. But I got to explain to you how this works. Okay, so if you go here, it's going to be Credit Karma. I switch from Credit Karma to Credit Sesame back and forth. If you don't have this system, please get it. Just click right through here and see my scores. But what you have to understand, these aren't the real scores that lenders use when you're applying for a mortgage or a car loan or things like this. But this is a good entry point. At least gives you some credit scores. They're called your Vantage score. The scoring system you really want to know when you're applying for a car or a home loan, you need to know your FICO score. So if you go to this system, go ahead and subscribe for it, but don't add any bells and whistles. Make it completely free. Don't pay for any of the charged features. If you really want to pay for something, what I'd suggest is getting your FICO support and score you have, because it's what lenders use, insurance companies use. If you're applying for a credit card, it's what they use. You can get that right through here. It's called Credit Scores and More, or True Credit Scores. It's going to go to My FICO. Hopefully it'll go to My FICO. And this is what you need. You need your FICO credit score. So by using this system, I think I make $1 if you sign up for it. But the good news is you get a discounted cost. You can see right up through here for the first month if you elect to stay with that system. But I always have people people go in here, please pull your FICO score and just look at it and see how it compares to your Vantage score. You might be surprised how there's a big difference there. And then I go through other things that I post on here periodically, but nothing there. Those are the two systems I would highly suggest you using, and the whys behind it. So that should, unless you guys have any other questions, let's just go through where we are for today. Mortgage rates, they popped a little bit today. They're up 6 basis points. The MBSs are down 10. Here's the weird thing is the MBSs were up or down 10 yesterday, and there was no adjustment to rates, and now they're down 10 today, and the rates are adjusting. So I think banks are finally just saying, okay, rates are going to maybe move up a little bit. I don't think this will be long-lived because there's a lot of good data coming down the pike. For the economic calendar, what we have for tomorrow is, and the reason why I'm doing this, folks, all this plays a role in all this because the Federal Reserve, the economic news that we get, the economy, our federal deficit, all this plays a role in these things. So some of the biggest things that we're focusing in on right now is right through here. This is what the Federal Reserve watches. Okay, so the number we're getting tomorrow, right here. Okay, the unemployment rate. The numbers that we got today were dismal when it comes to ADP. So here's what the Federal Reserve. I want you to understand this sheet right there here that we're looking at. So what we look at a daily basis is the federal funds rate. This is the rate the Federal Reserve actually sets and controls. You don't pay rates on this. Basically what this is it's interbank lending. So what happens is when a bank doesn't have enough money at the end of the day to basically close their doors and be solvent, let's say, for example, they need $100 million at the end of the day to be solvent, and they don't have it. Well, they got to go out and get that money lent to them. That's the rate they pay, and this is interbank lending. But when the banks, their costs go up, well, they're going to increase their cost to us. So when this goes up, usually short-term loans go up, like car loans, credit cards, and things like that. As this comes down, you'll see a lot of those come down as well. But the bad thing is also your savings account yields and stuff will go down. But what they're focusing on is they're saying, okay, we want to really pay attention to the inflation and the unemployment rate because this is their mandate. They were created to keep these two in check. Right now, the inflation that they monitor is at 2.3. It upticked just a little bit last time. Folks, I know I keep telling you guys, as soon as the housing data really catches up with this number, you will see this number at 2% or lower. I promise you on that one. But now the unemployment rate's supposed to come in. Last reading was 4.2. What's it supposed to come in at this time? Well, it's supposed to come in, I think, at 4.3. So if there's an uptick in the jobs report, but look at this report over here. This is ADP, and I think the markets really didn't move that much on this. It initially did at the get-go. But this number is a huge miss. ADP, they came out and they actually had to revise their last reading number because it was wrong. They said there was going to be about 100,000 new jobs created this cycle. There was negative 33. Huge miss. So I think the markets are just finally starting to discount this, and now they're saying, okay, let's just wait till tomorrow because we're going to get actually the unemployment rate from the federal government. We're going to get non-farm payroll, initial jobless claims, average hourly earnings, and all this is going to transpire by 1 o'clock tomorrow because the markets are closing tomorrow for the holiday Independence Day on Friday. So this data, the Federal Reserve right now is saying if there's more weakness in the job markets, we're going to cut. Because even the Federal Reserve's chairman said yesterday in a meeting with the European central banks, he said if it wasn't for the tariff news, we would have cut rates by now. So that is good news that they're finally looking at a lot of the data out there. But hate to say it, I kind of agree with them on the rate cuts. I would want to know what the tariffs or how the tariffs are going to affect inflation before I really made a move. So that's what we're looking at for today in regards to that. I just want to make sure you guys understand how to read interest rates, but and also why I ask so many questions when you're out there trying to look for a, what rate can I get? Well, I need all my questions answered so I can give you a precise number. So let's get over to my website. Here's what I need you to do. If you're watching this video and you're looking to buy and you want some advice on this, please check out the rateupdate.com. You can do one of a few things. Give us a call. Either Alan or myself will be answering the phone to answer any questions that you have. Alan's been a business partner of mine for years. He has as much experience as me, and he's as good in this business as I am. So feel free to talk to him as well. You can ask me a question right through here. You can click that and just ask a question. If you're looking to put in an application, we love hearing from you first, but you can do that right through here. And I'll give you this promise. We're not going to pull your credit, folks. It's going to cost us about $200 to pull your credit. So please, when we give you a call to go over your consultation, please answer the phone because I need to know your story. I need to know, what your credit scores are, what you're looking to do, how much money you're putting down, and so forth. If you're a new home buyer, check out this video right through here. We have a new investor that came on board 2 weeks ago that's given $7,000 away, or up to $7,000 away if you're looking to buy a home. Now, there is income requirements for this, so I'm going to walk you right through it in this video, and I'll even give you a link to the map. You go in and you plug in your address, plug in your income, and it'll say, yeah, you qualify or you don't qualify. So that's one piece of the puzzle. We did add a tool up here. It's called the loan estimate. And this is where a lot of you guys are asking, hey, Dan, should I lock in? Well, please do me a favor. I'll give you my advice, but once you lock in, do me a favor and go here and upload it. Let me review it and see if I can get you a lower rate, maybe lower fees. So that's what you can do right through there with a loan estimate review button. But if you're a homeowner right now and you're looking to refinance, I also have another tool for you guys, and it's up here saying refinance. What this does is so many people missed. Every time the rates came down, they kept missing the opportunity to refinance. They're like, man, rates went down to 6.25 and I'm at 8, and then they spiked back up to 7 something. So if you don't want to miss it again, check out this one. What this is going to do is you're just going to give me your information on your current mortgage. What's the rate? What's the loan amount? And so forth. What rate do you want to refinance? Now, if you're at 8.25, folks, don't put in 6. You could save a lot of money at 7. If you're at 7.5, you could probably save a lot of money at 6.5. So don't try to go from 8% to 5. It might never happen. So if you're at 8% or 7.5%, you're seeing rates looking like this. Reach out to us. See what the savings would be and what the cost would be. Maybe it might be worth it. So that's what you can do there. And so basically that is our report for today. So hopefully you can find some value in here. We also have a bunch of mortgage calculators up here to help you out if you're trying to figure out some numbers. But other than that, if you guys have any other questions, I'd love to answer anything else that you have. Otherwise, I'll be getting off of here so I can start working on some of the pre-approvals that I got for the day, and make sure I get back with Trevor with his question out there. So if anybody has any questions, I'd appreciate you posting them now. If not, I'm going to head out and start working on loans and getting ready for my closing bell video. I'll give it nothing out there. So we will end that for the day, folks.